Morning, everyone. Thank you very much for making the journey on a slightly damp November day. I do a little intro, bit of a technical spot, but there isn't much technical happening at the moment. We'll hear tomorrow from Mr. Jeremy Hunt as to what changes he might be making on taxation. We'll see. They're all talking about inheritance tax, but who knows? He's keeping his powder very dry at the moment. So by the end of tomorrow, we'll know how much poorer we are, depending on what they announce. Angela sends her apologies. I'm sure most of you are aware of Angela's situation. She's pretty much in safeguarding mode with her husband Duncan, so she's not attending the presentations at the moment, but she sends her best. Well, that's it really. I don't have anything else to say at the moment, but I'll hand you over to the team who will tell you what's been going on in a very tumultuous year and how your money is doing. Far more important.
Thank you, Brendan. I have to try and stay on my mark. Yes. I don't know if you noticed this, there is a mark here. Apparently I'm supposed to be just behind it, and then when I do this, then the audiovisual guys get very stressed, so I won't make their life too hard. I have a new presenter before we get going to introduce you to Natalie, who is with us from Morningstar Investment Management. I think you're all aware that Morningstar acquired Premium, the platform on which we hold much of our client money, and as part of that acquisition, Smart Investment Management. And you've been hearing from Nick for many years. He's been presenting with us here. Smart Investment Management is now part of Morningstar Investment Management. It's merged in. Natalie has joined our investment committee, I'm delighted to say, as part of that process. And it will be Natalie you're hearing from going forward at these presentations. Nick sends his very best. Says sorry he wasn't able to say goodbye in person, but events overtook that one. So, the usual starting point, as Brendan said, how are things going? We always start with the numbers, then we try and put some context around those numbers and see where we go from there. So, this is the first graph that I drew, which is the performance, as you can see, for the 6 months since we last met, basically, so the second and third quarter of this year. And when I saw that, I thought, gosh, that's incredibly busy. That looks like things are up and down like a yo-yo. But then I realized this is an issue of scale, because that graph rescales itself automatically. If you put it on a more normal size, it actually looks like that. In other words, sideways. So it looks really busy until you put it on a more normal scale, and this is on 0 to 30% of returns. Essentially, over that period, it's been pretty flat. Markets have tried to get going several times and get momentum and have fallen back, okay, as concerns about inflation, interest rates, and all the sort of things that Natalie's going to cover in a minute have been in people's minds. But it's been a fairly flat period. But actually, I think with everything happening in the world, it can feel like it's been a worse time than it really has. The world feels like a pretty terrible place at the moment with Gaza and Ukraine and everything else. And I think sometimes we can think that stock markets reflect that, and they don't always. So I actually thought it was interesting to look at, my brain works often in calendar years, random points I know, but you think, well, what's this year been like? And if you look at this year, it looks like that. So modest gains from sort of the 2% up to the 4.5%, pushing 5%. But actually, it's been an okay year. Not spectacularly exciting, but it's okay. You are making money this year. But it can feel very different, can feel like it's a really difficult year. It's because it's been volatile and because there's a lot happening in the world in general. If we look at the longer term numbers, this is the 3-year numbers. They are largely positive. If we look at the period since Gaia is our sustainable positive impact portfolios. These are the green bars. Our red bars are our core portfolios. And the grey bars are the sector averages. In other words, the average performance of a fund of a similar risk level. I think we've touched on this before. We don't seek to outperform our peers all the time, but over the longer term, it's nice to know you're doing better than the average, so we do keep an eye on it. So again, you'll see generally things are positive. 5-year numbers, we know it's been a pretty okay period, and it's good to see that those portfolios are all ahead of their benchmarks. Gaia is just approaching its 4-year anniversary, so it doesn't show on that graph. And the 10-year numbers, again, it's been a very good time. You see how that's scaled. That's up over 100% at the upper end. And again, it just shows that if you let the compounding take effect, that whilst markets can be volatile in the short term, if you're in the market long enough, then you can make returns. And the pleasing thing is, across all of those portfolios, we are well ahead of the sector averages. So they are performing at a better than average rate and at a very positive rate. So that's what the numbers look like at the moment. I'm going to pass over to Natalie, who's going to give a bit of meat on the bones as to exactly what's been going on.
Thank you very much, and good morning, everyone. I will also try and stay on my cross, although I do tend to like to move, so I'll try and stay put as much as possible. As Andy said, there is a lot of volatility at the moment in the market, so I'm going to unpack some of the themes that have been really driving that over the past 6 months and kind of beyond. But what I will say, and as I'll put more context on, is that volatility does open up opportunities because you get a lot of mispriced assets, and therefore it does enable us to go into areas that otherwise wouldn't possibly be as much of a better opportunity. So first of all, what I'm going to do is I'm just going to have a quick overview of what's been going on in various markets around the world, starting with some equity markets, so company investments. You've got regions going over the top and to the right, and also bond investments at the bottom and slightly to the left. So I'll just start by mentioning the US, but I'll go through the US in a bit more detail because there's been only very few, or a handful of companies that have really been driving the US markets this year. Second positive performance then in terms of Japanese equity. So Japanese equity has been performing well for a variety of reasons. First of all is that companies there have been improving policies in terms of how they are managed, better governance, accountability, which has been driving revenues, profits, and therefore share prices. Also in Japan, they've had an increase in exports, so the amount of goods that are leaving the country, and that's because the yen, the currency, has been depreciating, so it's actually cheaper for overseas firms to buy Japanese products. It's like if you're going on holiday and you're buying the currency of where you're going. If that currency has fallen, the pound buys more of that foreign currency. So same in terms of exports, so that's been impacting as well. And also companies in Japan have been going into more spending in terms of future-proofing the companies, which has been beneficial for shareholders and investors. So good news from Japan there. Taking a slightly other direction is Asia ex-Japan, and a lot of this is made up by China. So 34% of that market is made up by Chinese equities. China has had a pretty unsuccessful run of late, to say the least. As we'll know, kind of pre-6 months ago, they have been impacted more so with COVID because of their stricter lockdowns. Property issues have also been coming into the mix to impact the market, and also geopolitical issues and tensions with other countries. So it hasn't been ideal for that market. However, there has been some positives, although it hasn't really played out. So back in November, casting our minds back, China relinquished its zero COVID policy, and there was a big anticipation from the markets, an expectation that this was going to be a huge consumer-led rebound like we had in the likes of the UK and the US. It didn't quite materialise because we've seen the furlough payment in the UK, cheques being sent out to individuals in the US. That wasn't a system that was used in China, and therefore there was fewer built-up savings to have that huge kind of consumer-led rebound. Mix that in with some property issues continuing and also some geopolitical tensions kind of rumbling on. It has caused, over the last 6 months, pretty much since the rebound, for the market to fall back. I'll come back to China when I talk about opportunities. It's not all doom and gloom. But just moving on closer to home, the UK and the EU, less positive this year in terms of the last 6 months. Concerns around kind of growth, slowdown. The year, which you'll see the numbers underneath the blue, has been better. in terms of energy prices, driving some of the UK companies, and some extra rebound from the European market in terms of exports, but not so great over the last 6 months. Moving then on to fixed income, so bonds, so lending to companies and governments around the world, hugely impacted by interest rates, and I'll go through that in a bit more detail as I go through the slides. But just focusing here on UK government bonds, a huge fall in prices from UK government bonds last year, and that has continued, unfortunately, this year, down around 6.5%. That has really been driven because prior to just recently, the inflation in the UK had proven stickier, and so the Bank of England have had to do more this year to increase interest rates, which again I'll talk about more in a few slides' time. That has an impact on falling prices of bonds, which lifts up the interest rates on bonds. Not, excuse me, not quite the same across all different assets within the fixed income market. You've got corporate bonds, so lending to companies, but also at the higher risk end, so higher yields, so just higher interest rates on certain bonds, the higher risk element of the bond market, performing slightly better. They're less impacted by rising interest rates. So moving on then, key themes that I'll be whizzing through over the next 10 minutes or so. Higher for longer, and I've put this in because with a big question mark because it really relates to higher inflation and interest rates, and I'll be unpacking that in the next slide. Cash is an attractive investment. Given interest rates has risen, it has increased what we can gain on our savings as cash, and I'll kind of unpack that around other investments as well. And AI, artificial intelligence, and this gives you a clue of what's been driving the US market since the beginning of the year. So, first of all then, excuse me, inflation then. This is looking at inflation in the UK, very colourful chart with each of the colours representing different assets that are measured by inflation. And I'm not going to go through all the numbers because that would take me all day and be very boring. But just looking at the top in terms of where we peaked so far in terms of inflation, around 11%, and that has been tracking down. It did stagnate for a little bit, around about 6 or 7%, and we got the latest figure last week, which fell down to around just over 4.5%. So inflation is falling. It's being a little bit stubborn, and it's coming down slowly, but it is closer, and if nothing else, closer to the target of 2%, which you can see running along the bottom here. And if nothing else, it means that Rishi Sunak has met his target of halving inflation by the end of the year. I'm not sure he had an awful lot to do with it, so I don't know how much credit he can take from that, but it was something that he did promise, so he can hang his hat on that. Inflation then, so what does it mean for investments? And what I'm going to kind of focus on here is in terms of the ability to spend. So inflation means that prices of things that you buy on an everyday basis and more kind of one-off items increases. So the amount of money that you have today will need to be more next year if the prices keep rising. So from an investment point of view then, whether that's in the cash in the bank or investments in a portfolio, those assets need to increase in terms of their value to enable you to purchase the same things next year, the year after, and so on. And that's even more important as we have longer term savings, because that can have a detrimental impact over the longer term. So when we're thinking about investments, then we need to be able to beat inflation in order to have that purchasing power, be able to purchase those items in the future. So your money needs to grow at least in line with inflation. So if inflation is high and actually beating assets, whether that's cash in the bank, as I said, or investments over the longer term, then we need to make sure that we are, like I said, at least keeping pace with inflation to ensure that we can buy things in the future. So how do we get inflation to fall then? Well, there's not many tools that the Bank of England have, but one of them is interest rate rises. So this is kind of a long-term chart going back to the turn of the millennium all the way through to pretty much present day. And we can see here that there has been a huge increase, a very steep, quick increase in interest rate rises. In the US, it stands around 5.25%. In the UK, again, around 5.25%, and in the EU, around 4%. So, what impact then does higher interest rates have on investments again? So, first of all, with bonds, as I briefly mentioned at the beginning, if interest rates are rising, the price of bonds actually falls because it makes the interest rate that is attached to that bond less attractive. So the price of the bond falls and that interest rate that you get on the bond actually rises. But not great if you have, a bond portfolio that is being more impacted by this because the price falls. From an equity point of view, so a company point of view, it makes refinancing for company debt more expensive, therefore impacting their profits and therefore impacting their share price. So if you have companies that are more indebted than others and having to refinance that, then they're having to refinance at a higher rate and pay more interest. Also, it means that companies that maybe want to expand, so increase their debt to expand, are maybe less likely to do so because they're having to borrow at higher rates. Also, increasing interest rates then does have the impact on culling demand, and that is what is the idea in terms of reducing inflation. You reduce demand, you reduce the level of inflation. So that's exactly what the Bank of England are trying to do. However, it does have more of a delayed impact. Now, the UK is a pretty good example of that because most people in the UK who have mortgages on properties have either a 2 or a 5-year fixed rate mortgage. So there are many millions of more homeowners that are going on to or going to be rolling on to higher rates in the coming 2 to 3 years if they haven't already. And therefore that will then obviously impact their purchasing power and therefore the demand on different products, which should bring down inflation further. But what the Bank of England do not want to do, and other central banks, is increase interest rates too much, cool demand too much, that in the future we have a turn down in the economy and a potential recession. So lots to think about from the central bank. Not a job or responsibility that I would want, but at the moment most central banks have paused for now in terms of interest rate rises, although Andrew Bailey, the head of the Bank of England, did come out this morning, I was reading the article, and saying that interest rate rises may still have to happen if we can't get inflation back down to the 2% target soon. So in terms of then are we nearly there yet then, in terms of have we reached peak rates? Well, the market would then suggest that peak rates are close, if not we have already reached. But like I said, it could be that we go further in terms of increasing rates. But they are starting to have an effect in terms of bringing down inflation, which is good news from the Bank of England's perspective. So I mentioned cash, so moving slightly back to cash, but in terms of the impact that will have in terms of an investment. And cash rates, like I said, have increased, and therefore savings, cash in the bank, is earning much more. But what is the long-term impact of investing in cash? Now, this chart here looks at returns above inflation, which is exactly what we want, at least. It looks at around about just under 100 years of data and looking at average 3-year returns. Now, you can see here that 82% of the time, equities beats inflation. So that's pretty good odds in terms of equities. Overall, beating inflation 82% of the time. Bonds, not too bad either, just over 2/3 of the time. So 68% of the time, bonds beat inflation, which is also pretty good news. With cash, it's just over 50-50. So 56% of the time, cash in this analysis has beaten inflation. So it just goes to show that investing over the long term is more beneficial for beating inflation if you're more invested in equities and bonds very broadly as opposed to cash. Cash, however, is important, and actually it has reasserted itself as a viable hold for short-term spending needs, which is great news because over the last 15 years or so, investors have had to maybe go for more riskier assets just to try and get a yield on their short-term spending. And therefore, it's really good news that cash is now providing a decent enough return to provide a return on those kind of short-term emergency-like spending needs. So that's good news. There is also good news for other assets as well. So just turning to this slide, here we're looking at the interest rate that you can get on lending to the US government. So US government bonds across as little as a month, all the way through to 30 years. Now, 24 months ago, so end of September 2021, interest rates were around about 0.25%. Seemed like a long time ago, but they were down there. And the interest rate that you were getting on a short-term bond was pretty much zero. So no return from an interest rate perspective on that bond. If you go through a longer term, you would expect usually that the return to increase because you're lending for a longer period of time. But even then, you're talking around about 2%. So not a great deal of return from an income point of view on US government bonds. Fast forward just 2 years, and now on that short-term debt, you're getting around 5.5%, which is pretty good news. So you're pretty much getting what interest rates are. So that return is much better at 5.5%. And even on long-term bonds, you're getting just under between 4.5% and 5%. So much better than we have experienced over the last 15 years. And that's great news because it means that we can include these in the portfolio and we can kind of buy into areas that have repriced, because this rise in interest rates is great, but it means that the price of the bonds has fallen, but it means that we can target areas where the price has fallen to enable us to lock in these higher yields. So much better return for investors. Okay, going on to a bit of a lighter topic to finish off then in terms of AI. Hope you're all still with me. So this is looking at 7 companies that have really had a huge impact in terms of driving returns over the US market. Split into 3 different sectors, even though they all look like tech companies, and you probably recognize a lot of them. So I'll start with NVIDIA, maker of chips within the technology sector. Also within the technology sector, you've got Microsoft and Apple. Within the consumer communication services sector, you've got the likes of Meta, so the owner of Facebook and Instagram. And you've also got Alphabet within there. So tech-heavy names, but within a different sector around communication services. And then finally, you've got consumer discretionary. So you've got Tesla in there and also Amazon. So again, pretty tech-heavy names, but within the consumer discretionary sector. Now, this is a chart of year-to-date to the end of September. And as you can see, if you can see the axis there, it goes up to 200%. So some of these names have driven a lot of performance this year. In fact, compared to the index of the US, so all large companies that are listed within the US, these 7 companies have driven 85% of returns in the first 6 months of this year. So a huge impact from just 7 companies. So when I showed you at the beginning that return of the US market, most of that is driven by these 7 companies. Now, before we get so excited and want to flip our investments into these 7 companies, I'll just show you what they did last year. So this, pretty dismal performance last year. And actually, only a couple of names have then recouped the losses that they had last year. Now, the point then to show you is it's really important when we think about investing and what including within a portfolio, we really have to look at the underlying, and is that share price of whatever company we're looking at, whatever region we're looking at, whatever sector we're looking at, is that representing the value of the company? Because if it's overvalued, then you might want to avoid certain areas. If it's undervalued, it might give you an opportunity for investing, at a really attractive price. So, to finish off with then, looking ahead, are interest rates likely to go higher? What a good question. So it's not beyond the realms of possibility that interest rates go higher, but we can protect against this within the portfolio. Shorter term bonds, whether that's government or company bonds, react a lot less in terms of their price fall to interest rate rises, which is good news. Also, certain equities, so companies, do react better to interest rate rises. Think banks If they are being able to charge more for their lending, then they're increasing their profit margins there, which we have seen already over the past 18 months or so. Will inflation go higher, lower, or remain unchanged? Now, at the moment, we're on inflation is falling. So prices are still rising compared to 12 months ago, but at a lesser rate, which is good news from an economic perspective. It isn't, again, beyond the realms of possibility that inflation could increase again. We've got a lot of geopolitical risks, unfortunately, around the world, and that could cause inflation to go higher. There is, however, protection within the portfolio that we can protect against that scenario. Inflation-linked bonds, which are priced at a much better rate within the UK, can protect against this, and also certain equities. Energy is a good one to protect against inflation. So again, certain things that we can include that can protect against that scenario. Will there be a recession or growth? So recession has been talked about for a long time, given that interest rates have been rising, which crushes demand, and therefore a recession had been maybe expected. Most regions have been able to fend off a recession for now, but again, it's not beyond the realms of possibility that this could happen. However, again, there are things that we can protect against from an investment point of view. Bonds really come into their own when we have an economic slowdown, because what tends to happen is in a recession or economic slowdown, interest rates are cut, which will impact negatively your cash savings. But in that scenario, the price of bonds actually rises and therefore offsetting some falls elsewhere. Also, from an equity perspective, we can look at defensive assets, so consumer staples, so companies that produce things that you really have to buy, and also healthcare and utilities areas as well, which provide more defensive properties in that scenario. And then finally, geopolitical unrest. Now, unfortunately, there is the unrest in Ukraine and also more recently in the Middle East. Again, more defensive assets will be able to protect against these uncertain times. Markets hate uncertainty, and therefore having more stable assets within the portfolio does protect against that. So it's not all doom and gloom, like I said at the beginning. There are opportunities where uncertainty does present itself. So where are we finding that? So just to end on then, I mentioned China and the woes that China have had in terms of a fall in the equity market. We actually see this as an opportunity because we see this as a lot of the bad news is really priced in. So going back to that, what is already priced in? What should the valuation be based on the fundamentals that are driving that economy? And we feel that China is a market where there is positives. Like I said, a lot of the bad news is already priced in. They're getting more positive economic data. There was a meeting between Xi and Biden to try to negotiate some of this kind of political tension. And also within that, China aren't having the inflation issues that we're having in other places of the world, and therefore they can look to reduce interest rates to help both companies, individuals, and the economy in general. So we do feel that the long-term story in China is positive. Secondly, Japanese yen. Now, I mentioned that the yen has been falling against the pound, and therefore we feel it's reached a level where it does present a good opportunity for investments. We can gain that exposure through investing in equities or very short-term Japanese government bonds, because we do feel that the currency will revert and appreciate against sterling, which will be beneficial for investment returns. And then finally, other areas like Latin America, where we're finding opportunities within there, UK equities, and also financials as a sector. And also in terms of bonds, where we can seek assets that have reacted maybe more negatively towards these interest rate rises. Back in just October, so just last month, we switched into some more US government bonds based on the price falls that we've had within that market, which can benefit us going forward, like I said, locking in at those higher rates. With that, I will stop there and hand back to Andy. I hope that's been useful, and I look forward to taking any questions later. Thank you.
Thank you, Natalie. And well stayed on your spot, by the way. That was excellent.
Very adamant I was going to do that.
Right. So I was when I was thinking about a month, 6 weeks ago about what exactly to do, I thought I'd do a little bit about, we're talking about investments here and investment markets, but we are a financial planning company fundamentally. And I think sometimes we can lose the connection between how the investment engine is driving the financial planning. So I wanted to talk a little bit about that. And also, there's an interesting behavioral finance thing in here about how we all behave as individuals, and how, with Black Friday fast approaching, most things in life we like to buy as cheap as possible, with the exception being investments, where we find it easier to buy them when they've been going very well for quite a long time and have actually got quite expensive. And some of the dangers of that behavior, because it's quite hard to buy an investment when it's really cheap, because it means it's done horribly badly recently, but we dash out on Black Friday trying to buy everything half price. So I just want to touch on that a little bit. There is a video here. You know I like a video, for those of you who are regulars. It's not long, I promise you. Some of you will recognize it. I have stolen it from a particular well-known Belgian beer manufacturer. Hopefully the audiovisual guys will be able to get this on the stream as well.
Bonjour.
Bonjour.
Je pourrais avoir un casse-croûte au jambon, s'il vous plaît.
Ouais.
Merci.
Ça fait 10 francs.
J'ai pas pris mon argent. Vous voulez...
Ouais.
Particular brand has decided to go down a route of reassuringly expensive. And that is actually how we often buy investments. They have become reassuringly expensive. They've done rather well for a while. I feel like they must be good, and they're going well. And I want to look at an example that's come up recently where a number of cases have gone to the Ombudsman that show some of the dangers of falling into that trap. Now, this graph shows you the performance, and I'm looking at a 10-year period in total here, but this is the first 7 years, and it relates to one particular individual who complained to the Ombudsman about what happened to his pension. Now, I'm going to talk about what happened to this gentleman at retirement. I appreciate some of you have been through retirement, but it's just an example of how financial planning investments need to mesh properly if your planning is going to work. There'll be other events in later life as well, but this is just one example. So this is the Scottish Equitable Retirement Pension Fund. And that's a 7-year track record, and over that period it did 6.5% a year. Very nice, very steady. The reason this is important is that if you took out a Scottish Equitable pension years ago, they're now owned by Aegon, so the name Scotec isn't really around anymore, but the pension fund still uses that name. They had an option called lifestyling, and this gentleman took out a Scottish Equitable pension in 2012, and lifestyling was an option that became popular about 25, 30 years ago, where insurance companies were aware there was an issue that people would take out a pension, say in their 30s, and they would put it into equities. They'd go for the higher risk funds because they had 30 years to go and they didn't mind the volatility, so I'll go for growth. And that made complete sense. And the pension built up over the years, and then what often happened was they forgot they were still in equities, and then as they got to the point of retirement at, say, 65, 6 months before, there'd be a stock market crash, and their fund would drop 40 or 50%. And they'd get their statement just before they retired, and they'd go, what on earth happened? So they put in a thing called lifestyling, which basically was designed to de-risk you when you got near retirement, to move your money out of equities into supposedly safer, lower-risk investments, typically government gilts, so lending to the UK government, maybe with a bit of cash as well, to avoid this problem happening. Now, we've never used lifestyling for 2 reasons. One is, when you're 30-something and you select a retirement date, the chance of you getting it right is pretty slim. So you're all de-risking around a random date you selected 30 years earlier, which probably isn't actually when you're going to end up retiring. So there was a danger that you were doing things around the wrong date. But the second thing is, not all low-risk investments are low-risk investments all the time. And this is what this example shows. So this particular gentleman got, at about the end of May 2020, got to this point here, and he had selected lifestyling on his pension that he took out in 2012, it was actually. And as requested by him, Aegon, the owners of Scottish Equitable, moved the money into this fund, which, as you see, had a decent, steady track record. Okay. Then that year ended, but the gentleman decided actually what he was going to do was not retire for another 2 years. I guess the pandemic changed his plans, as it did for many of us. So he said, can I extend my pension for 2 more years, please? And Aegon said, yep, no problem at all, we will do that. And he stayed in the same fund. He didn't talk to them about the fund, didn't make any request to move it. He stayed in it. So, unfortunately, there is another 3 years then, beyond this, that he was actually in the fund. He wasn't actually in it during this period. He was in a different fund. And the 3 years that he experienced looked like that. He lost 40% of his money in 3 years. Now, why did that happen? That happened because that fund consists of 75% UK gilts and 25% money market funds, cash. And UK gilts got incredibly expensive. Incredibly expensive. Now, anybody working in the markets, like ourselves, knew that. We didn't have UK government gilts for a number of years because they just became very, very high risk. And we knew this, so we avoided them. And I'm glad to say then, when this happened, we weren't too exposed to it. Okay? You can see how this fund was driven. That orange bar, graph, line, is the Vanguard UK gilt index. That is what UK government gilts did. They actually fell about 50%. The Scottish Equitable Fund, fortunately, had about 25% in cash, which helped offset some of the fall, but this gentleman still got very, very badly hurt. And the reason he got hurt is because he didn't understand that this low-risk fund was no longer a low-risk fund. And this is how you need to be watching the investment engine all the time and updating it, or your planning will fail. The plan in 2012, when he took out the pension, it seemed to make sense, but events overtook it, and he didn't adapt. To give you a feel for what we were doing in that period, we knew that there was a problem here. We had traditionally used gilts as a safe haven and a place to hide and cash, but we stopped doing it in the mid to late teens and started using our absolute return portfolio, which over that period did that. So none of you went through this because we knew what was going on with gilts. Anybody in the market knew what the problem was. Now, this gentleman went to the Ombudsman and said, Aegon should have advised me to get out of this fund. Because a year in, when he extended, he was only about, where are we, about here. He'd lost about 10%. So he said, when I said, could I go another 2 years, please? You should have said to me, you can, but you need to do something with that fund. You should have advised me of the problems and the risks in that fund. And Aegon said, we're not financial advisors, we're a pension company. You didn't ask us for advice. We don't give advice. We're a pension company. And the Ombudsman said, they're right. It's not their job. If you wanted advice, you should have gone and got it. And unfortunately, this gentleman thought that he'd got it sorted, and he didn't. So there's been a number of complaints on the same fund gone to the Ombudsman. The Ombudsman has kicked them all back and said it's not Aegon's fault, it's not their job. So I just wanted you, it's an example of how it's really, really important, one, to have that ongoing advice so that somebody is keeping an eye on what's going on so that a plan is updated. But two, not to fall into that reassuringly expensive trap of thinking that something that's always done well will always do well. These things don't happen that way. Okay? That is the whole period, the whole 10 years. So, you know, it did great. Very easy to buy that fund there, and then unfortunately gravity kicked in. So it's just an example of how the two need to mesh, your investments and your planning. Here's your have I got news for you moment. Your question of the day. That I put up, I'll give you a clue. We did our first of this cycle of presentations in Blenheim Palace, and I put that up there, and I thought I'd keep it for here because I think it's slightly bizarre. Can anybody tell me the story behind that? It's been in the news recently. That is reassuringly expensive, I promise you. No. I was caught by this. That is, as it looks, that is a solid gold toilet. that was in the news about 3 weeks ago because the 4 gentlemen who stole it from Blenheim Palace, where we were doing our presentation, went on trial. Anyone want to hazard a guess what that's valued at? It's 4.8 million. Okay? And funny enough, you had to come in here today across the grass or in the tradesman's entrance because they had a catastrophic roof leak the other day that they are doing emergency repairs on down the normal corridor. And they've had big water damage here. When they stole this was actually genuinely plumbed in. It was an art exhibition. An Italian artist made this toilet. Where on earth this Italian artist got 4.8 million pounds worth of gold from is beyond me. But anyway, made this toilet, and it was actually a working toilet, plumbed in and everything. Although I suspect nobody sat in the middle of an art exhibition and used it, because that'd be rather embarrassing. And when they stole it, because they ripped it out at 3 o'clock in the morning, they burst the pipes and unfortunately caused water damage through, obviously, what is a Grade 1 listed building. Yeah. But it just goes to show that, expensive stuff isn't always a great idea. All right, because they are now facing a fairly long period in jail. I just wonder, the one question I have is, who were they going to sell that to that wouldn't spot where it came from? I don't think there are too many solid gold toilets around where you could say, no, that's not the one from Blenheim Palace. No, this is my one. I didn't steal that, not at all. I have to assume they intended to melt it down, but anyway, they didn't get that far. So anyway, back to more sensible things. I'm going to hand over to Phoebe, who will talk to you about a particularly important subject that's been going on in the world of suitability and impact investing. Phoebe, thank you.
Thanks very much, Andy. Oh, that's a good start. So, we're coming up to COP28. Those of you may know it's being held in Dubai this year. Starts on the 30th of November, which is next week. Obviously quite a controversial climate change conference. So COP is the annual climate change conference held by the UN. All or as many as possible UN member states come to whichever city it is or whichever part of the world it's in to try to advance climate change negotiations. So we're on COP28, the 28th meeting. You may remember last year was held in Sharm el-Sheikh in Egypt, and it was a spectacular failure of a COP with regards to advancing negotiations. The previous year was in Glasgow, which was a lot more conducive to advancements. But the fact of the matter is we are miles behind where we need to be from a climate change negotiation perspective. And there's a lot of emphasis and a lot of expectation that whilst holding it in Dubai, the president, Sultan Al Jaber, who's head of the biggest Dubai or UAE oil and gas company, so he has big stakes within the fossil fuel industry. There's a big expectation that he manages to bring negotiations forwards by bringing those oil and gas CEOs to the table, the negotiation table. So with that backdrop and the fact that we need to make progress very, very quickly, I wanted to just talk about the energy transition and where we are on that pathway. So the goal of the energy transition and the concept behind the Paris Climate Change Agreement, which was a COP held in 2021, the 2021 COP, was to agree, and this is where all UN member states made this landmark agreement to try to commit to keep temperature rises at 2 degrees or at best 1.5 degrees above pre-industrialized levels. And that was some backwards calculation, figuring out the volume of carbon emissions that the world can take in order to limit global warming to that degree. And that degree parameter was calculated off what the world can really take with regards to temperatures going up, droughts, floods, how much heat capacity can we take as civilization. So in order to get to the 2 degrees or 1.5 degrees, and you can see there's the parameter there, we need to halve global emissions by 2030, just in 6 short years, and get to net zero by 2050. Net zero is not zero because we're still going to be producing carbon emissions as a global community, but there are these really helpful natural carbon sinks that exist. Whether it's trees, we all know about that, and rainforests, but also salt marshes, which there are more and more of here in the UK. Whether it's seaweed, whether it's oceans, these are all the most powerful carbon sinks that exist today. So it's as much about reducing carbon emissions as it is about restoring and protecting some of the most important things that we have in front of us, which is nature. And those two elements of the energy transition are equally important. So with that sort of synopsis, where are we? This chart I will make sure I read out to you because it's not particularly clear. We have here the temperature range, 2 degrees to 1.5 degrees. And where we need to be reducing, this is gigatons of carbon up the side here, reducing the amount of carbon in the atmosphere, obviously downwards, between now, well, 2015, now-ish we're here, and 2030. So that shows you the reduction in carbon that's required. The grey line along the top here is policies that were set back in 2010. So that's pre-Paris Climate Change Agreement. We have the current policies that have been set. These are just commitments, promises, maybe empty or otherwise, set by governments. Even with all of those policies and commitments and strategies in place, we're still, as you can see, absolutely miles off where we need to be to reduce carbon emissions by 2030. Then you have 2 NDCs. So the NDCs are the national defined contributions. This is what a country has to bring to a climate change negotiation. They have to come with a really detailed plan of how they are planning, this is the UK or China or France, how they're planning on reducing carbon emissions in line with what they've agreed to, which is this commitment here. And you can see even with the unconditional and the conditional scenarios, what they take to these negotiations, again, we're quite some way away. So there's a lot of work to do, and there's a lot of, this year is being called the global stocktake. And what that means is that every single NDC plan is being rigorously analysed by the environmental programme of the UN at this COP. It's the first time that's actually happened. It needs to happen every 5 years, and this is the first 5-year time span that global stocktake is going on. So certainly more work to do. And unfortunately, the UK hasn't been going on the right trajectory with regards to net zero. Now, there's certain justifications behind the rollbacks that we've seen, and those justifications orientate around a cost of living crisis. And we can obviously understand in the room here that there are many parts of this country and many demographics whereby if they have to replace their boiler, going to a more renewable solution versus a gas boiler is going to be prohibitive to some families. And I completely understand that, and I'm not denying that issue doesn't exist. There's a real tension here between the environmental choices we need to make over the next couple of decades and then the cost of living crisis that we're facing today. So the ban on new petrol and diesel cars and the delaying the requirements is obviously a real blow from an environmental perspective for the UK. Equally as a blow is the North Sea oil licence that were granted, and that was all around energy security. Again, a tension that exists here, which is the security around energy supply today, even though those licences won't be delivering energy anytime soon, and the environmental issues that we face, and we really need to make those significant changes, as you saw on the previous slide. But the real, not the real issue, but the issue I think that really strikes home to me when I'm looking at the policies set by China, the policies set by Europe, the policies set by the US, the policies set by the Middle East, quite frankly, these days, is that the UK is becoming further and further behind on the political spectrum. If you look at the global landscape, we're putting our country at, sadly, a competitive disadvantage by falling further and further behind and not setting these ambitious policies. Because the ambitious policies, or the lack of them, means you aren't attracting capital or brains or investment in UK PLC. And there are many really exciting, fast-growing businesses that are in the energy transition. That chart that we saw there around AI, I think if we fast forward 5 years, every single major company or unicorn will be those companies that are delivering these energy transition solutions. Because that's what we need, and it's where the money's flowing. And sadly, right here, right now, the UK is not going to be part of that mix. One of the important things to bear in mind, however, is the UK is one of very few countries in the world where net zero as a concept has actually been legally bound in our legislation, and that was done under Theresa May. So there are certain mechanisms that exist within the UK legislation that mean that there's still going to be progress made even if we haven't got the policies to match. And one of those policies, or also one of those mechanisms, is around the carbon, effectively a carbon tax that exists. So each and every year, every industry in the UK, or the majority of industries in the UK, are given an allocation of carbon that they're able to produce through their operations. And that's measured at the sort of standard industry level. If a company overshoots or is energy inefficient, they effectively have to buy the ability to pollute a ton of carbon from the market. So you have this carbon price. Now that obviously encourages companies to be energy efficient, otherwise they have to have an additional outlay in terms of cost of paying to pollute. The amount of allowances that are produced each year goes down every single year, forcing companies to become increasingly efficient. So I've spoken to you a few times about the importance of financial markets, and this I think is a really good example of that within the energy transition space. You can't do enough through philanthropy, you clearly can't do enough through government policy, and incorporating the corporate world and markets is a very important part of this transition continuing to happen. Outside of the UK, there's some really positive news. So last year, I was talking to you about the Inflation Reduction Act. This was the groundbreaking legislation passed by the US. The reason it's groundbreaking is it gives tax credits, so money off companies' tax bills, if they make their investment in everything from renewable energy, green hydrogen, electric vehicle manufacturing in the US. In the US, you've seen 270 new clean energy projects announced since this time last year, and that in totality, that involves around 132 billion. Importantly, this is all about job creation as well, and there's specific legislation within the US tax credit structure, whereby if you give jobs to people living in the US citizens, you get additional tax credits. So really trying to stimulate job growth at the same time, and that's created over 130,000 new jobs in the US as a result of this package. You may be thinking, we've spoken about the energy price going up, there's energy insecurity issues. Where does the investment in renewable energy fit versus fossil fuel investment? Well, you might be surprised to know that there's been more investment in clean energy, green, than traditional energy, blue, actually going back since 2016. And you can see the gulf here is huge, and there's a chart later on in the presentation that shows that in a different way. So this is 1.7 trillion a year to be invested in renewables this year versus the 1 trillion in traditional. So you can clearly see the direction of travel, even if the policies aren't quite stacking up as of yet. What does this look like outside of the US? Well, we have here a chart from the International Energy Agency showing the split of renewable energy, grid, and that's a question that probably some of you have asked me before or will continue to ask me. It's all very well producing this solar energy or wind energy. What if it's not sunny or windy at that time? That is where grid storage is absolutely crucial part of the picture. We've got investment in renewable energy, grid, fossil fuels and nuclear across advanced economies. So the UK's, the US, the Europe's. China as a standalone, I mean, it's the absolute outstanding investor in renewable energy, as we probably know, and then emerging markets. Across all three areas, investment in renewable energy, and this is going 2011 to 2016. The middle one is 2017 to 2020, and then the blue one is 2021 and beyond. You can clearly see increases in investment in renewable energy across advanced economies, China and emerging markets. Unsurprisingly, the reduction, given the chart I showed you before, and also really importantly, the investment in grids going up as well. What about inflation? We've spoken a lot about inflation earlier in the presentation. Natalie's covered a lot of charts on that. What does this mean for renewable energy? Do we see the investment in renewable energy as additional inflationary pressures? I mean, quite possibly. But if you look at the cost of clean energy equipment, it's actually come down substantially. So you're looking at a reduction of 250 effectively on this index in 2014, all the way down to 100. So a really, really, really significant fall in the cost of producing clean energy equipment. Now you've seen a bit of an uptick, but nothing really in comparison to the steep falls you've seen in the cost of producing this energy. You've got here again a similar demonstration really of the cost of batteries, storage batteries, electric vehicle batteries, and wind turbines and solar panels. Again, really falling price, demonstrating on a levelized cost basis. It's still cheaper to be producing renewable energy, excluding all subsidies, than fossil fuels. So still investing today, pound for pound, you're making more money on the renewables. I promised you I'd show you a chart on that reduction in investment in fossil fuels. This shows here the same picture in a different way. So this chart here shows the amount of cash that's produced by a fossil fuel business and where that cash goes. The cash, if it's being reinvested by the oil and gas company back into oil and gas, the bar is blue. If that cash has gone back to shareholders through investment, through dividend payments, it's in orange. And then if they're paying off debt, it's in yellow. So you have the chart here from 2008 to 2021, and this is the split of where that cash is going. If you go back to 2016, 90% or more than 90% of the money produced by an oil and gas company goes straight back in to reinvesting back in their core product, into oil and gas. That figure has fallen now to below 50%. So this is one of the clearest pictures for me that the oil and gas industry itself is not reinvesting profits back into its own core competence. Now, clearly, the disappointing figure is how much money is invested in renewables, which is microscopic. You can barely see it. They're giving most of their money back to the investors, and unsurprisingly, given where interest rate payments are, they're actually paying debt off to prevent having to pay for that level of debt that they've got. But the clear trajectory is down. So us as investors, if we're thinking about, I run sustainable portfolios and the Gaia portfolios, but as a traditional investor, Natalie is there thinking, what is the time frame in which I'm comfortable holding these assets? Yes, okay, 1 year, 2 year, 3 years, you can probably make a case. But over the longer time period, if the oil and gas companies aren't even investing in their core competency, you've got to really question, does it make financial, economic sense to be holding over the long term? So it's a bit of a mixed bag, to be honest. I haven't really got sort of a clear picture. You can clearly see that more work needs to be done at the policymaker level. But I think the positive to be taken out of this is the markets are working in the way that they should. You're clearly seeing investment going of the opportunity for tomorrow, the renewable energy production of tomorrow. Encouragingly, you're seeing a lot more investment in grid technology. And I think my message really would be try not to get too disillusioned or disappointed with some of the headlines that we're seeing here in the UK. Clearly, we've got a political battle going on and will be resolved, I would imagine, next year, probably autumn next year. A lot of those headlines are feeding into that battle and trying to distort the picture when really the energy transition is absolutely underway. I think it's a wave that's far too big to be pushed back now, both in terms of what we need to be doing environmentally and also the volume of money that's really going in that direction. So we'll keep investing and hopefully still find many opportunities for your money. Thanks.
Thank you, Phoebe.
Oh, I'm staying.
Yep, Q&A. That is the usual disclaimer. Don't do anything rash without talking to your advisor. Don't steal gold toilets or drink too much. Stella Artois, I guess, is the takeaway. I'm just going to shut this down so I'm not absolutely blinded while we do Q&A. Does anybody have any questions or comments? And we have some questions that have come in on the stream, so thank you for those of you that are on the stream. Anything in the room before we go to Jennifer?
One of the things on inflation.
Oh, sorry. Could you, my fault, I should have said, could you wait for the microphone so those on the stream can hear? That's entirely my fault, I apologise.
Question on inflation. Years ago, we had a basket of goods and items. Nowadays, it seems holidays are bought into inflation figures, which really are irrelevant to a lot of people. Why do we keep changing the baskets on inflation? Shouldn't they be food, electricity, oil, gas, whatever, as opposed to some of the luxury items?
I can tell you what the theory is. The theory is that they try and represent spending across the economy. And obviously, they update as the world changes. So clearly, many years ago, the price of a bag of coal would have been in there. Probably less relevant to most of us now. Now there'll be the cost of an iPhone in there because that's more what we spend our money on. So it's just designed to reflect all of it. If you did, the core cost, if you like, you kind of get a different inflation number. You get a consumer staples inflation number. Now, all these numbers are actually calculated, and we look at all sorts of different inflation numbers. So there are numbers for what core services are doing or what consumer staples are doing versus other things. But the government publishes the headline numbers, which is basically a headline rate, and then a core one that takes out food and energy because they're the more volatile parts. But there are numbers done underneath that. So it is studied and it is calculated. They just think that it gives a more rounded picture. It is clearly an educated guess. How do you reflect all of our spending? We all spend on different things at different ages, at different times of our life. They're trying to capture, I guess, an average of all of us. That's the theory. Yeah. Yes.
Biden is rather unpopular at the present moment. His numbers are going down, and he's done a great deal in the line of what you just said in global warming and what have you. There is a prospect, however, of someone like Trump coming back that might put things back even further. So how damaging do you think we could see things if the Americans change?
I think it's a really interesting question because you have this situation where Trump might pull the US back out of the Paris Climate Agreement. But if you look at the states that have benefited the most financially from the investment in the IRA, it's those Rust Belt states, it's the red Republican states. So I think you might have a sort of bifurcation situation where headline, the US doesn't care about climate change. Underneath the bonnet, there's still probably record levels of investment that are going on. So from an investment perspective, I don't think it will change a lot. If anything, I think it will provide a really interesting opportunity because I think the asset prices might well fall as we get closer to the election because I sadly, like you, probably think that Trump's going to get back in, looking at the numbers today. But actually that will provide a really interesting opportunity to get access to some assets that will be undervalued given the investment opportunity and probably the commitments that he's going to uphold in some of those states like Texas. Texas has benefited the most from investment in wind power, for example. So it's a bit of a kind of blurred picture. He'll go out and say some really, really bold and anti-climate change statements to appease his voters, but underneath the bonnet, something else is likely to be happening. Yeah, I mean, obviously. I think it's pretty, I would be surprised if that doesn't happen and that difference in terms of what's happening and what he's saying is happening.
So a dishonest politician, who knew? Yeah. Say one thing, do another. What a shock, yeah.
The danger I think we have is the independent, because I don't know if you remember when Bloomberg was going to stand, the reason he didn't stand in the end is he said, I'm the biggest threat to the Democratic Party, because I could potentially stand as an independent, and then it would pull votes from the Democrats that would then twist in terms of the overall weighting towards Republicans. And you do have this risk of the independent party driving more and more votes on a relative basis away from Democrats to Republicans. So we'll see what happens in the end. We'll see actually who the nominees are. But yeah, definitely one to be watching. I don't know what you're doing from an investment perspective on that.
Yeah, so it's hard to predict what's going to happen. Interestingly, it's a question about Trump that we've had at every one of our events. So clearly a hot topic among clients. When we look at investments, we try not to hang our hat on things that we can't say for sure. So we can't say for sure things like, where interest rates are going or if Trump is going to get elected. There is, when Trump was in power last time, it actually drove the US equity market forward because he cut taxes for companies. He's also interested in that, given that he owns a lot of companies. And therefore, it actually drove share prices within that area. But like I said in my presentation, we really have to look at what the company is actually worth under the bonnet, because he probably won't be prime minister. Well, he won't be prime minister for, maybe if he's 4 years, president. Sorry, president for.
I was going to say, I just wanted some kind of alternative reality.
For the longer than the 4-year term, and we have to think long term. What are these countries, regions, companies actually worth? What is under the bonnet? What are their revenues going to be doing? What are the profits going to be doing? Therefore, what the share price is going to be doing, rather than kind of pinning our hat on a prediction that we can't possibly know for sure. So we can't predict, and therefore we don't plan the portfolios that way.
It would maybe entrench this idea of the trade war, though, between the US and China.
So that has had an impact on the likes of technology prices as well, because that has had an issue in terms of what's being produced in each nation. They have had talks, though, more recently, President Xi and Biden, and therefore we're hoping that the tensions will ease slightly, but they're always going to be there, and they've been there for a long time, whether it's with Trump or whether it's with a different president. So we do again have to think about, okay, well, what impact could that have from a scenario point of view, and what can we include in the portfolio to protect against that? But ultimately, again, for the longer term, we need to think about what will be driving these companies from a bottom-up perspective.
Jen, you've got one coming in on the stream.
I do. Right. So the first one. What impact do you think a spike in global energy prices would have on markets now, and do you think it's likely to happen again?
The main implication would be inflation ticking back up again, which would mean that interest rates would have to respond to that and either go up or stay up. Obviously, we saw a spike in the oil price with the outbreak of the tension or conflict in the Middle East. However, the oil prices have come right back down again. So they're sitting around $82 a barrel today. But that is an outside risk. I think that is probably the major risk to central banks and to us as investors, really, that inflation re-peaks and then interest rates have to keep going up.
But as Andy said, one thing that the government probably, or the central bank, look at probably more so than headline inflation, which includes energy prices, which does cause inflation to move up, is core inflation, which excludes the volatile sectors like food and fuel. Now, that's not to say that it's not important. However, that's what they'll be basing their policy decisions on more so, because energy and food are quite volatile areas that can impact inflation. Therefore, unless there's kind of a dramatic shift, we shouldn't see a dramatic shift in the policy from the Bank of England.
Just on that one, I think it's because I think the reason they break it down that way is that, you know, we regardless of what prices do, we will still eat and we will still heat our homes so that we don't catch our death of cold. So that what those prices do doesn't necessarily help them. If they take those out and look at what we're doing on things where we don't have to spend the money, that more discretionary spend, and they see that still continue to come down, that gives them some comfort that actually we are still slowing down in how we're spending our money. We are still putting our horns in, and therefore inflation will still come down. The other bits, we just have to spend the money. I mean, we all saw it. Our electricity bills and gas bills went catastrophically high. I think our home literally at one point had trebled, more than trebled, nearly quadrupled. But you still put the heating on because it's flipping cold. So that's not really where they focus. They look for that evidence that we are bringing our spending down, and that will gradually bring things back down.
Right, okay, so my next question here. I know Phoebe's just mentioned a little bit about the UK carbon budget. Someone's pointed out here that Canada has recently introduced a carbon tax which goes back to the residents, and asks if could or would any other G7 countries do the same?
So most countries have a mixture of the emissions trading scheme, which is the thing I mentioned to you, where companies have an allocation of carbon that they can work within. And if they exceed it, then they have to buy from the market. If they undershoot or are more energy efficient than they are expected to be, then they can sell those credits back. But there's also a carbon tax also in play in most markets. The money doesn't go back to the residents in the case of Canada. You might know that Canada's pretty far ahead when it comes to carbon legislation. So it might be that they're testing the waters there, and it's something that we could see elsewhere, as in the money going back to the residents themselves.
Brilliant, thank you. And I've got another one here actually on the green transition, which asks, can climate capitalism work? If we're going to make the green energy transition, do you think this aligns with current consumer behaviours? I didn't submit these myself.
No. Great question. So I was very confidently telling you there that the levelized cost of energy for producing renewable energy and fossil fuel goes in the favour of investing in renewable energy, but that's for the energy companies themselves. As us as individuals, we need to be these costs to be neutral in order to make more sustainable choices, or potentially cheaper to therefore incentivise us economically. Now, the more investment that we have, and the fact that we've got almost double investment by those renewable energy companies versus the fossil fuel companies is almost double this year, and we saw those really, really strong trends, would mean that there will be more capacity, there will be more supply for us as consumers. But it doesn't just go within the energy space. I think that's quite a sort of limited read. We're talking about every single industry having to decarbonise. So it has to make economic sense for these businesses in every single industry to do that themselves. It's not all on us as consumers. It's not all on governments either. There is a significant portion of work that needs to be done by the businesses and the business community, which is why I'm sure Morningstar and LGT are pushing businesses and will only really invest in businesses that have strong transition plans themselves. And the reason behind that is unless businesses are focusing on the energy mix of tomorrow, then they're not going to be able to retain talent, they're not going to be able to attract talent, they might be losing consumers. And also it demonstrates they're not a very visionary or forward-looking or efficient business in their own right. So all of these are not values-based decisions, they're very corporate and financially based decisions. So I think that from my perspective, carbon, what did they call it, carbon economics?
Carbon capitalism.
Carbon capitalism.
No, climate capitalism.
Love this phrase.
Like that.
Absolutely is starting to work. And the fact that we've got all those three parties involved and part of the mixture is crucial. But the fact it is now very much market-led and very much business-led means that I believe that it is happening, it's already around us, and we're finding companies uninvestable if they haven't got legitimate transition plans in place, because what it demonstrates to them, to us, about them as a business in their own right. Did you have anything?
Yeah, just on that. So we don't run portfolios as the Gaia portfolios, but what we do look at in every portfolio that we run is environmental, social and governance risks. So because this gives us an extra level of due diligence just to look at where their future revenues are coming from. So as Phoebe said, it's really important, regardless of the company, regardless of the portfolio, to have that extra level of checks just to make sure what plans are in place, what policies are in place, where are they going with their money, how are they going to be creating revenue in the next year, next 5 years, next 10 years. And part of that is this energy transition. So whether it's an environmental portfolio or otherwise, it's still very important to check to have this extra level of checks to see the future viability of these companies going forward.
I think I've just got an example on that I had a conversation with a fund manager recently. We were talking about cement companies. Now, cement production is an industrial process. It chucks out a lot of heat, it uses a lot of chemicals, and but there are very well-run, forward-thinking cement companies and really old-fashioned, backward-looking cement companies. And the point is, if you're going to invest in them, if you've got the cement company that's already got their emissions down significantly, is going to be able to sit within its carbon budget quite comfortably going forward, maybe has carbon capture to try and catch some of emissions and so on, then they're not going to end up paying those huge taxes, fines that the more backward-looking one that hasn't done all that work is going to. So it's just a better investment, not on a sustainable or positive impact grounds, although that's also true, purely on an investment basis. So it really matters that these factors now that will be applied kick in. The other thing I'd say, climate capitalism is a great phrase. There are some really visionary people in business. Microsoft offset all their emissions and are planning to try and calculate their entire emissions in the history of the company. How on earth they're doing it as a massive project, because they just want to, and they're going to offset all of them. That's a massive project to even calculate it. That's completely voluntary. That's the leadership of that company saying, we want to be more than we have to be. We want to be a leader in this. Yeah? But not everyone's like that. So ultimately, the way you get businesses doing things is you financially incentivize them by hitting them in the pocket if they don't. So I think climate capitalism, you want to call it that, I think the systems that are in place will work, because even those people who don't really want to do it will just have to do it because it's bad business not to. One more from Jennifer.
I do, sorry. It's my last one.
No, that's cool. More the merrier.
Right. And this is interesting, I think. We've talked about this quite a lot in our committee, and it's to do with mining for all the metals and minerals we need for green technology. However, this question asks, is deep sea mining a worse alternative for sourcing these metals and minerals than, I suppose, traditional on land?
So there are various scientific studies giving you two very different answers to this. I think the headline is that not all deep sea mining is the same. There are obviously examples of deep sea mining where you are literally ripping up the seabed in the way that trawler ships do, over mass spaces in order to be able to mine for the lithiums or the nickels, the cathodes that are in the seabed. Now, quite clearly, undertaking something where there isn't a lot of scientific evidence in terms of the overall impact, there's a massive lack of scientific science really about the sea in general. There's a lot that we don't know. So undertaking an enormous new way of extracting mining minerals or metals from an ecosystem that we don't really understand doesn't feel like a great idea to me, particularly when you're racking up all of this seabed, which is so important with regards to extracting carbon. So I'll give you an example. Phytoplankton, which is obviously one little species of plankton, is the most carbon extractive organism in the whole world, including all trees, everything. So the fact that you could start to undertake major deep sea mining, which would really, really damage, just let alone all the animals, but actually the ability to extract carbon is huge. That being said, I did meet with a company which is listed on the NASDAQ the other day that has an operation where they are just collecting, and they showed me this video, they're literally scooping, little grabbing things that they've got on these robots, grabbing the bits of nickel from the seabed with no disruption at all to the phytoplankton, no disruption to the carbon extraction processes that are going on, and then extracting those and using those. So then the trade-off is the robot collecting the balls of metal from the seabed with no disruption better or worse than the mass biodiversity loss, the mass water usage, the mass land disruption that you get if you're going to mine a new lithium mine or nickel mine? The world of sustainability, the world we live in, is all about compromise and weighing up what's better or what's worse. We know we need a lot more lithium. We know we need a lot more nickel. So the answer to the question is it kind of depends on the deep sea mine we're talking about. From my perspective, there are companies doing it in the right way, in a sustainable way, but there are also loads of companies that are just destroying the seabed in the process. The UK has signed a memorandum to say no deep sea mining. They're very, very anti it. There are other countries like the US and in Scandinavia, interestingly, where they're much more pro-deep sea mining. So it's quite a political thing at the moment.
Any? No?
On that really granular question. Yeah. We can wrap up.
It's fascinating, the idea of literally just going in and picking off bits and from the seabed. Yeah, is amazing. Yeah. If that's all the questions, obviously we will be here afterwards if anyone wants to grab us one-on-one. I've had the signal that food is here. You know the deal by now, those of you that have been here before. Feedback equals food. All right? So could we have your feedback, please? We do find it very useful. So if you wouldn't mind filling out the form and handing it in to any one of us, we'd be very grateful. And then please come and join us for some food. We'll get that opened up so you can get through into the next room.
Great.
Thank you for your time.
Thank you.
Thank you.